afternoon, everyone, and welcome to the webinar on understanding multifamily real estate syndication. I am your host, Rashmi Chanduraj, founder of Westkey Capital Partners, and I'm thrilled to have you here as we dive into the powerful investment strategy that we're going to talk about today. Have you ever wondered how you can participate in like a large scale real estate investment without like the hassle of, direct ownership? That's exactly what we're here to explore today. I know that many of you, the idea of investing in a multifamily syndication, one, not knowing what it is, might seem both sort of exciting as well as maybe a bit daunting. At least it was for me. That's perfectly normal. It's perfectly normal to have these concerns, especially if, this is like your first time you're exploring this type of investment. But at the end of this session, what, we'll hope to do is get a clear understanding of how to assess a syndication and a syndication deal, what the benefits are, the risks that are involved, and also get into sort of actionable steps, to get started. If you're new to sort of syndication, you might be concerned obviously about, potential risks and the complexity of the process, or even the lack of control, as a passive investor. Today, we'll kind of tackle these fears directly and show you how to navigate them, and you'll be a little bit more confident in moving through that. Now, I'd like to introduce to you our guest here, Jim Stewart. Jim is from Westkey Capital, and he's begun his journey in multifamily in 1991. I think he first acquired an 8-unit building, and today he's been involved in thousands of units as both a general partner as well as a limited partner. With over 30 years of experience, Jim has built several successful companies, including like a global manufacturing and distribution business. He's here to share the real world examples and practical strategies to lead us to a win-win outcome for investors and management teams. Before, I hand the mic off to Jim, I just wanted to outline that, a few things that I wanted to call out just from a housekeeping thing. We'll obviously have enough, time in the end for questions, but I encourage you guys to post any questions in the Q&A section, and it will come both to both of us, and we'll be able to, tackle those. I'll be fielding most of those questions. So feel free to, ask any of those questions in the Q&A section. And, with that said, let's dive right in and discover how multifamily syndication can be valuable addition to, your investment portfolio. Jim, can you share briefly with the audience how you got started in multifamily real estate? What attracted you to the syndication as an investment strategy?
Sure, Rashmi, very nice. Thank you for having me here, and appreciate the kind words in the introduction. For me, yeah, I'm showing my age here, being over 30 years involved in it, but it's something I really love. And quite honestly, at the beginning, it was a hobby, and we'll call it a profitable hobby, because my wife and I were both professionals, and we did this part-time for a lot of years while we both drove our professional careers and also the businesses as well. But what I can tell you is that, excuse me, as we did it when we were young, we certainly had a big learning curve, being young people buying that first one. And I'll just back up. Even before we bought the first multifamily, we did probably what a lot of others do. We bought a house, we fixed it up, we bought a condo, fixed it up, and we were trying to make this money. And I remember the turning point for me is when we bought one of these condos in a fourplex, and this gentleman had bought this building with 4 units in it, and he had fixed it up, and then we paid our price. And so, of course, the idea was, well, hey, you can rent it and make an appreciation over time. But I realized after I bought it, because it was across town, it was a pain in the butt to get to because we were always driving across town to deal with an issue, or if it ran empty, it was 100% on us. It costs us money. The tenants, well, that was a challenge too, because we're self-managing, trying to find the right tenants. And I said, it's got to be a better way because honestly, this gentleman made all the money. And I said, I got to get one step back or two steps back of that. I said, well, how is it? Okay, well, he bought a very small multifamily because at 4 units and above, it's considered a multifamily. And because of that, I said to my wife, Joanne, I said, that's where we need to go. We need to be that person and adding the value to it and then selling it on if that's what we're going to do as one of the strategies. I mean, or even buy it and then create more value out of it and then enjoy the cash flow, but not buying it as a retail person. But that's all we could afford at the very, very beginning. So that was the transition. And then we had the opportunity right at that same time to transfer with our jobs to Calgary. I took with the same company I was with at the time, a very interesting opportunity managing that whole province and running a manufacturing facility there. Well, Joanne, at the beginning, couldn't transfer with her job, took 6 months and looked at multifamily, toured with a multifamily broker, specifically one, and that's what led us to actually buying a multifamily. And we stretched ourselves pretty thin, but we moved into it and we did all our own renovations. Joanne's dad would drive out every so often on the weekends to help us with the renovations as we value added it. And going back to that fourplex, we actually condo converted that because that was a great play in Calgary and we unlocked the money. And so we cashed out on that one, did it again. And then we shifted more into the longer term holds, which is kind of where we continue to this day, where we look for appreciating assets that have cash flow and the back end to them. And that then allowed us then to take a look later on because we did it all ourselves. But in 2015, we actually started in the United States. And the syndication rules in the United States are so much simpler than in Canada that we said, well, we've had friends and family asking if they could invest with us. And we kept saying, no, it doesn't really work. And well, now with those different rules, it really opened up the door for us to explore that. And the benefit of that, of course, was that we could even go after potentially even larger projects or do more of them quicker. And that's kind of what drove us all the way to here. So why I love syndication.
That's awesome. How long did it take you just from, moving from that fourplex to, going into a larger deal in a
Well,
syndication?
there's a broker, Mike, who was the selling broker of the fourplex or eightplex to us. Or it was not an eight, it was a beautiful apartment block. And just to conceptualize for you, it had units from 825 square feet up to 1,550, two-story, open vault in the family room with fireplace, 3 bathrooms in this thing. They were very nice units. And so it was a very custom, unique build, 3-story apartment with a cantilevered parking for protection. So it was a really neat building. But that particular broker, we got to know because the broker we dealt with kind of moved on, but we approached Mike, and Mike was somebody in that city. He really was very, very entrenched and knew pretty well. If he wasn't involved with it, he knew about the deal. And for whatever reason, he took us under his wing. And it was because of Mike and Mike's ability to put deals in front of us and I would say, Mike, there's no way we can do this. That's too big. We can't pull down 96 or 128 units. And so we jumped I think it was 32 units, and we did a fourplex in the 32, and then we were looking at these bigger deals of over 100 doors, and I'm going, how? But because of him and his mentoring for us, it allowed us He opened up the door, excuse me, for financing, connections, all these things that we're going, we don't know how to do. So, a lot of credit to Mike because of that. And so that's really what made the difference for us. He pushed us out of our comfort zone. Otherwise, I think we would have had a very gradual process.
Which is, so true for so many of us, isn't it, in real estate, that, we just don't know what we don't know, and, until an opportunity comes along. So that's fascinating. One of the things that I wanted to, also, talk about and understand for the, and especially for the audience is, especially for those where this concept of syndication is new. I know there are so many nuances that goes into what is, a syndication. Can you, sort of explain what multifamily, like real estate syndication is? Like, how does it look? Like, what are the different nuances that are there? And we can, like, let me know when, you're ready, and we can share, the little,
The
video
video.
that you put together,
Yeah, why don't we do that first and then circle back, because that video, Westkey, the company that we have in the US, we put it together to help people understand what is syndication.
Yeah,
And I think once that's played, then let's dissect that a bit.
sounds good. Let me see if
Are you tired of missing out on the perfect real estate investment due to insufficient financing? In today's fast-paced market, time is of the essence, and waiting for the required capital can be a frustrating experience. But fear not. There is a solution that can help you overcome this hurdle: real estate syndication. Let's dive into the basics. Real estate syndication involves a group of investors pooling their money together to build or purchase properties. This partnership consists of two main players: the general partners and the limited partners. The general partners are the masterminds behind the scenes. They assemble the deal and take charge of managing the entire process. Typically, they are a team of experienced real estate professionals with strong connections to multifamily brokers. They scout for promising opportunities in emerging markets, conduct thorough evaluations, negotiate with sellers, handle due diligence, file necessary documents with the Securities and Exchange Commission, seek and secure the required equity and financing. Essentially, they handle everything needed to run the syndication smoothly. On the other hand, we have the limited partners. These individuals are passive investors who contribute their funds in exchange for equity in the deal. They rely on the expertise of the general partners to make the investment successful. Now, let's talk about how our investors receive returns. At Westkey Capital, we typically employ a 70-30 straight split, with the limited partners owning 70 of the deal. We aim to deliver attractive returns to our limited partners with an average cash-on-cash return of 6 to 8 and an average annual return of over 18. Every quarter, our limited partners receive distributions, providing them with consistent income. In addition, our general partners keep investors informed about the performance of the property through regular updates. At Westkey Capital, we specialize in upgrading assets in emerging markets to enhance the living conditions of our tenants and generate high-yield returns for our investors. Our strategy revolves around value. Add programs which involve acquiring properties, renovating them, raising rents, and holding the assets to distribute returns. When the timing is right, we sell the properties, capturing the potential for massive upside. If you're seeking to diversify your portfolio with a cash flowing asset that can also provide tax benefits, real estate syndication is an excellent choice. It offers stability and security that surpasses the stock market and cryptocurrencies. Now is the perfect time to educate yourself about real estate syndication. Visit our website at www.westkeycapital.com.
Yeah, a lot to unpack there.
Yes, yes. And I'll say that that's one way to look at it, because syndication itself, you can syndicate a lot of different things. Multifamily, this is how we do it ourselves, but you can syndicate interest in a lot of different avenues and other type of asset classes as well. And then within our multifamily, you can have different styles of investment within there and different criteria and that sort of thing. But the key here is that it allows typically an individual, I'll just say, if it was my wife and I, if we flip right back to when we were buying our duplex or our single family home and we were fixing it and we had a certain amount of capital, well, we can only buy to a certain level there, and we can only get a certain amount of profit. But what syndication does, it opens up the door for you to be involved in a much larger property, a much generally a better style deal, not always, but generally that's the premise of it. It opens up the door to participate in a larger deal where there's more upside in it, and there's more ability to unlock that value. And then there's a bigger buying pool at the end to sell it. And those are some of the big things. And then you as a person can decide, do you want to be a limited partner where you are passive, but you're getting a great rate of return that you would, and you don't have to put the time in, but you're getting this great rate of return. Or you can be an active partner and actually running the deal, involved in the deal. And there's a lot of moving parts with that. But if that's where you feel you're being pulled to, then you can be part of that group that is actually the doers, the active part of the deal. I'll just say for us, we're on both sides of the equation always. We need a place to put our money to help make money, but we also love the business and have a lot of experience in it. So I think with that experience allows us to be able to unlock potential. And I'll just say no one has a better vested interest than the person with the money in it. So you're in alignment with everyone else at that point.
Yeah, no, absolutely. I think, so just to clarify, when you say you're both a limited partner and a general partner, you mean on the deals that, you're working on, correct?
That I'm directly involved with, yes. Now, I am also invested in other opportunities as well. It's not that I invest 100% in ourselves. We like to diversify ourselves as well. But yes, when I said that, yes, we put the money in as a passive investor, and then we were also actively involved with the deal.
Yeah, that's great. So I think having, what they say is like skin in the game, right? Like, especially on your deal, you also have your money locked in. So obviously, as a general partner being active, you want to see sort of that success, of that particular deal. That's great. Talk to us, Jim, about sort of the risks and rewards that are associated with, being a general partner versus being an LP. And, and I say that because obviously I started as an LP and invested, as an LP for a number of years. So I do see, the benefit of being able to just get, like they say, mailbox money, right? Like money in the mailbox. I did nothing for except for invested, my funds. Compare that to what the risks and rewards are of being a general partner.
So, well, obviously, if you're the general partner, all eyes are on you. You're the one that's created the business plan, or the team has. You're the one responsible to make sure it works and have the accountability to make sure it works. Generally, you're also the one that's on the loan. So you've given your guarantees that this is how it's going to go, and things are going bad, it comes back to you as the general partner. So those are some of the risk. The upside, of course, is if you really do know how to navigate. And I'll say every deal has its own life. So there's not one deal that's identical to the other. They're all organic in how they move. And so you have to have the business experience to zig and zag and apply those business principles to whatever the solution is at the time, and holding people accountable to drive them towards that. So creating a team, but also it's really important. I know for us anyway, and other people have different ways of handling it, but one of the things that we do is we like to create a great community for our tenants to live in. And so we don't really call them tenants, we call them part of the family. And so they have this great place to live. And because they have this great place to live and we take care of them in terms of maintenance and we're improving the place, generally people will be willing to pay more. And that then translates to the LPs, where now that invested dollar unlocks a rate of return for them, because you're being rewarded for the efforts of making it a great place and improving the place for people to live. That's our style. Now, there are different styles out there where it's just more like a momentum play, right? Where you just buy it and it's just cash flowing and that side of it. And it's pretty straightforward because it's fairly new, probably. There's a lot of different styles that way. But as a general partner, those are some of the risks. And I don't know if you want to talk about the limited partner as well.
Yeah, no, absolutely.
Sure. So for the limited partner, it really comes down to, well, there's a lot of different components into that, and maybe you'll help me kind of work through all of these. But essentially, with the limited partner, one of the things is you have to be able to recognize a good deal from a bad deal. And so you need to have a bit of understanding of how the deal works. How do you make money on this deal? And if you have that comfort and the location and the exit seems to make sense, and the projections of the cash flow that are being presented to what's going on in the market seems to make sense, then you really then are going to want to look at the team. And who's this team? Are they people that you feel can execute it? And so usually that comes down to, have they done it before? Have they worked together? What are the roles of each of the people in it? Does it seem logical with the roles for these people? Do you think they can succeed with your money? And if those are all yeses, then you then finally have confidence to invest the money. And then the premise is that as a limited partner, you're going to want to get your updates so they tell you how it's going against the plan. And so you can continue to feel confident with it. And if it's not going where it is, then you need to be asking questions of the general partners and holding them accountable to what they said. And essentially, then, as you use the word mailbox money, if things are going really well, which generally that's the premise, is then you've got this mailbox money coming in, and you get to enjoy your life. And so you're not spending a lot of time each week worrying about it or managing it, which is the benefit of it. And as you build more of that mailbox money, then it gives you more time freedom. And so that's the ultimate goal, I think, for a lot of people that are with us. It's either they're still working people, and say working, being in their career and earning and saving for that point in time when they can say, hey, I've got choices now in life. And so this is one method of getting there a little quicker that allows you to have that freedom of time, which is what I think we all strive towards.
Yeah, no, absolutely. That's great. As far as, like with, especially as an LP, I know what you sort of, talked about is, almost like there are two different things as an LP that you're looking at, right? Like not just in terms of the deal itself, but now you need to do, some due diligence on, like who you're going to be partnering with, to do this deal. And there are obviously two different, steps. Now, in your opinion, is there one that comes first versus the other? Do you do it simultaneously? Because there's always that first initial step, isn't it? And, how do you go about doing or vetting a sponsor, for example? What does that process look like?
Yeah, no, that's a really good point. I guess part of it might be, how'd you hear about this opportunity? If it's from someone that's already actively invested with them and they're having great success, then how do you trust that person's recommendation? And that will help. And then you can ask them questions as well to learn about it. If it's that you don't know them and this is all new to you, then I would probably say, first thing, take a glance at it, see if it's even of interest. Because if it's of interest, then that's when you're going to want to invest the time. But if it's not of interest, then well, it really doesn't matter at that point. If it's just not the right type of deal for you, it's not the right type of asset class that you're looking for. I mean, there's multifamily, there's self-storage, there's assisted living, there's student housing. I mean, there's all these different types, RV parks. I mean, all these different type of things. And or there's outside of that whole real estate, office, you can get in. And so if it doesn't fit kind of where you're thinking, then don't waste your time. But if it is, then that's where I think, okay, now I would take a look at the deal and say, okay, yeah, this looks really interesting. Now let's see who the team is behind it and start asking some questions around that team. I will say that the people that are on the loan, they get scrutinized by the lender very, very hard. So from a legal, financial, all that side, they are not going to get a loan if there's any trouble. So as an LP, you already have that. If they are on loans, you kind of already know that if they are truly signing on the loan, they've been vetted from that angle. Now it comes down to ability to perform and track record. That's more what you want to be able to check out.
Yeah, yeah, no, I think that's a great point. Because obviously going with any sort of agency debt, meaning that, you're obviously going through sort of their, list of due diligence that they're doing on the sponsor who's going to operate this. So I think that's great. So, as an LP, I don't have to go running and trying to say, okay, well, let me do a background check on this person individually, before, investing in the deal, like as long as I have enough of a background of, what they've done and historic information, that should suffice. I do like that.
Yeah, and I'll just also mention that the lender wants your track record as well. They
Yeah.
want your bio. They want to get a sense, can you operate this as well? Because if you haven't done a deal or you don't have enough experience or it's outside of your area, they're probably not going to lend the money either. But
Right.
I still say with the LP, they need the confidence that this is the right team to risk or put their money with this team.
Yeah, no, that's great. That is definitely a crucial piece to, sort of that a syndication model. Can you talk to us about, what and maybe we can, tackle this later as well, but I think it's relevant here. What does an LP, a limited partner, and a GP, a general partner in a deal look like? Because I know there are several different splits, as they call it, meaning, just how much equity is going to be distributed between a general partner and a limited partner. Can you talk to that a little bit about what, what that would look like?
Sure, absolutely. And I'm going to say that it really depends on the type of group you're investing with, or there are REITs out there, they have a different formula. We're more considered a boutique, small investment firm specializing in the lower size deals, 35 million and below, where we feel there's a niche against the big institutional players. But they all have slightly different structures to them, but there's still some commonality, we'll say, in terms of all of the terminology, like in terms of what the general partners would get versus the limited partners, and generally the costs that can be charged. Some may charge different fee structures, but there is that, I don't know if you've got a slide that you might be able to share as an example to help kind of run through it. And I think seeing the slide, I'll articulate a bit with it as opposed to just trying to talk about it without any sort of reference. But
Sure.
yeah, thank you.
We can bring this up. Yeah, we will jump right into this. So this is obviously just, one of the.
Yeah, this is a past deal, and this is only for educational purposes. I mean, this is closed and everything else, and just to give you some sense of one style of how it could look. In this particular case, this property was a purchase price of 13.1 million, 224 units. The whole time, 5 years, And our total raise on that was $7.2 million in this particular scenario. And yeah, we can go to the next slide. And so basically then you say, okay, well, how are you using all these funds? And as a limited partner, you really want to understand where the money's going and ultimately what does that mean once it's invested to me, which we'll get to in a minute or two. But you can see that we have the amount of capital that's come in from the different sources. At the top, there's the actual invested dollars. In this rare case, we had a huge credit because there was something that was not disclosed as we had been underwriting it, and it came out in the due diligence, and we had written documentation that we had asked all about it. So we had to go back and it's called retrade, meaning ask for a credit because our underwriting did not account for it. And so therefore we couldn't hold the rate of returns that we said we would give to the investors. Capital contribution TIC. This in this case is what's called a 1031. So there are people that maybe have bought a house or they've got an apartment complex and now they're selling it and they're allowed to 1031. So move it over tax-free into an entity, and so we can accommodate that sort of thing, and most groups can. And so it's a tenants in common structure that they do in order for those people to move their money invested tax-free. That gives you a total source of just over 17 million. Then you go, okay, well, now what do we need to pay for? So we've got the $13 million purchase price. I'm just rounding this legal. We need to get it organized and structured. And then there's the management organization due diligence fees. And we had some costs in terms of doing that due diligence and whatnot. So there's just over $500,000. Loan points, we hire a loan mortgage broker, and they're the ones that do all the work to put the deal together and work with us to secure the funding. So in this case, it's 94,000. We have other closing costs, which in some case, there's a more legal costs, other fees associated with due diligence and things like this that have gone on that add up. The lawyers like to get their money, let's just say that. And then we'll have lender required escrows. So when they've done the inspection on the property, sometimes they say, well, we require you to do these repairs immediately. And so there's kind of a 30-day and 180-day list. So they'll put those in escrow and want you to justify that you've actually done it. Once you've done it, then they'll release the funds to pay for it. And then we generally, in order for us to create money for everyone, we have a capital expenditure budget where we're improving things. And so not getting into all the details of this, but we had money raised for all of that. And then we always keep a contingency, a reserve for the skeletons in the closet, things we couldn't anticipate. So that's where we like to be conservative. So that's how that goes. If we go to the next slide, in this particular deal, it's cash on cash to 7%. Generally, what we're seeing in our segment of the market with these boutique we're seeing 6 to 8% cash on cash. Some people have a special class where it's only for a certain portion that's a fixed 10%, but then they don't participate on any of the sale proceeds. But we, in this deal, had a projection of an average 7% with 20% annualized rate of return. The internal rate of return is 16.3. One of the great things about real estate and why I personally love it is the tax deductions through depreciation. And there's this thing called cost segregation, bonus depreciation. And the government had it at 100%. And then last year went down to 80. This year it's at 60. There's rumors it might go back up to 100, depending on how it goes with the government. So essentially right now, it works out to 33 to 37%. Had it been 100%, it would have been more like 60%, but that's okay. It's still a pretty nice bonus to get, and it really helps defer your income. So essentially, a lot of investors, including myself, like it because we don't have to pay the taxes. And then when it gets sold, it's a capital gains and usually treated at a much more preferable tax rate. And then this equity split. So this equity split is important to note. Different people have different splits, but in our case, this deal, it worked out that the general partners are going to take 30% of the upside and the limited partners get 70%. And so, and that 70% is generating this rate of return, which is essentially 100% rate of return of your money in 5 years. And like I say, this is just an example. All deals are different, but it gives you a sense of a typical syndication deal. Now, if you're with other groups and or large institutional, they may have that down at 10% for the general partners or the REIT side, and 90%. But they also are buying typically different types of assets like Class A, different styles where it's got a lower rate of return. And so you have to decide what sort of risk tolerance you have and what type of asset classes you would want to be in. But what it does do, all of these structures allow you to get into larger properties, and you let someone else who's got the professional skills to manage this and unlock it without having all the stress directly associated with it. So you're not the one getting calls about issues or having to deal with it. You can just get your updates and obviously want to know what's going on with the property. But the whole premise is it unlocks you into this different asset class where you can generally get a better rate of return on your money, which for me and my wife was really what drove us to move towards this years ago. Was so it allows us the amount of cash flow to give us the time freedom away from being tied down to all these other commitments. And therefore we can choose to go travel or spend time with our kids or different things like this, the high priorities in life that you love to really be able to enjoy. So that was what drove us and why syndication really can help that.
Yeah, no, that's great. We have a question here in the chat that, they want to understand, how does taxes work when you join a syndication or when you syndicate? I know you touched on this, from a cost seg and bonus depreciation standpoint. Perhaps it might benefit the audience if you, say, stated as an example, like if you invest 100,000, what does that look like?
Sure. And I'm just going to say, I am not a paid tax consultant here, that you would always want to check with your CPA and that side of it. But I will give you my opinion, but please verify it. So if it was $100,000 investment, and generally, basically, if we had the bonus depreciation in year one, let's assume the property broke even. In other words, with its own depreciation, not the bonus depreciation, it's already at a zero basis. So there's no income that you have to worry about. What we're saying is, and sorry, one other thing I want to mention is our structure, we're in limited, like an LLC, so limited liability corporation. So the premise is that depending how you've invested, it flows straight through to you, and then you get the benefits. So as opposed to a corporation where it stops, C Corp, it's going to stop at the corporation and then you actually have to dividend out. So, and I'm already getting into more details than most people want to know, but basically with this flow through, it then says when we issue a K1 to you, showing you what our income was and what the potential revenue or loss is, it's going to show, if I go at the low end, 33%. So if it's $100,000, it's going to show a 33%, $33,000 tax loss that year due to the depreciation that now is showing on your K1. And assuming that you have the ability to use that, because for like within the real estate side of things, then you've got that tax benefit flowing to you that you're not going to pay tax on that income. whether it be this year or next year or future years, it can carry forward. So that is a nice benefit. So that, let's just say this property makes money 3-4 years from now, and you've still got this depreciation loss. Well, now you can use that and restate your income against those past losses and not pay the tax. So it's been great for us in terms of I'll call it kicking the can down the road, because you still have to pay your tax at some point. It's just that we've had enough depreciation not to pay it. And what it allows us then is to take that money that we haven't paid and reinvest it in and make money on the money while it's working till we owe it.
Yeah.
But you still have to pay your taxes. Don't think that you cannot not pay taxes. It's just a matter of when you pay it. Does that make sense, Rashmi?
Yeah, no, it does. Absolutely. I think that's one of the, like the biggest, movers for why people end up investing in real estate, and especially in the syndication model. One, you're not necessarily, actively managing it. You still do whatever you're doing, but you're, and especially if you're a, high income earner, you're able to offset some of this. Obviously, to your point, it depends on individuals, case. So consult with your CPA and your tax strategist for it. But there are definitely benefits, from that you could use and write off and, just defer it.
Yes, 100% agree. Yeah, it's one of the greatest in my mind, because I've been in different types of businesses, and I just love the depreciation, and also love the fact that, because one of the other benefits is that when you're in a syndication and you're borrowing the money, like if you said, it allows you to buy a larger property. And because you're borrowing this money, you can get pretty good leverage on these properties, depending on the quality of the property. We target 65% of the purchase price to 75% for the loan. And that's at a lower interest rate. And then that, because we've got that lower interest rate on that amount of money, it allows the capital that we do have, that we've raised, the capital employed, we call it, to earn the extra income against. So we divide the free cash flow against the capital employed or invested income. And that's how we get this nice rate of return on the money. And, but allows you to lever up. And real estate's one of those few things that, because it's an asset that the banks or lenders love, that you can do this with.
No, that's great. I also wanted to, get your opinion, Jim, on the equity split of 70-30. I know, like, there are others, to your point earlier, that there are others who would do a 90-10 or an 80-20. And there's also sort of, I want to say a school of thought where people would underwrite that. And when I say people, there are, operators that would underwrite the deal at 80-20, just to make the deal look good, and get a higher return. But, they might not have enough skin in the game, at that point, because they're not getting enough, returns, for the effort that they're putting in, but they're just making, the deal look good by only taking actually 20%, like, what's your thought on that?
Well, I like to think of it as a win-win. If everyone's winning, then everyone's in alignment. We're all moving parallel. If, to your point, someone is willing to discount their time, at some point, if things are not going right, that person's not going to be vested in it the same way. And I know when we've made our investments as a LP only in some, we really, I don't begrudge people making money at all, because the way I look at it as a win-win, if they're making money, I'm making money. And if they're highly motivated to get that rate of return for us, I'm okay with it, because I'm good with what the projections are. That's why I invested the money. And I would worry personally, that's my opinion personally, is that if there's not that perceived alignment, when things get tough, that's when things fall apart. And I want to make sure these people are committed and will. And I know they'll say anything at the beginning, but you just know human nature. And so, you know, your gut will probably tell you if it's making sense or not. And listen to your gut at the end of the day. That's very important.
Yeah, no, absolutely. You know, and I know we're 15 minutes, you know, to wrap up. I just want to also call out, if folks have questions, please post it in the, you know, Q&A so we can get to that. And you know, the other thing that I wanted to, you know, find out is, Jim, and this is a question that I ask everyone. So, you know, what would be something that you would tell, like, your 13-year-old self, if you were to go back in, you know, things that you would have done differently, perhaps, or, you know, like, you know, stayed the course, you know, talk to us about that.
Me as a 13-year-old. Okay. So that would put me, I think, grade 8 or something, to put context around that. I honestly, you know, I would probably say to my 13-year-old self, you got this. Believe in yourself, trust your gut, and and enjoy the ride. I'll just say in our case, success comes in many ways. Some people say there's financial success. I agree. That certainly is nice to have, but it's not great to have if you don't have the balance in life of everything else. So if you don't have your health, you don't have a great family, you know, a great spouse supporting you, you don't have the time freedom to enjoy it. And I'm happy to say that we're in that position. So what more could I ask for? So I just say to my 13-year-old self, keep going.
Love it. You
Yeah.
know, stay the course.
Yeah. Stay the course. Yeah.
That's awesome.
Yeah.
You know, I know we're you know, just, I think the wealth of, you know, sort of experience, we probably just, you know, got like the tip of, you know, the iceberg. There's a whole, you know, like area that's submerged that we probably haven't even uncovered.
Yeah, and I'm wondering if you want to just very quickly go to understanding multifamily syndication, the life cycle, just really quickly, because
Yeah.
that really is a great summary slide that can help. And so it's in the presentation here where you've got the deal sourcing. And so that's really important to have a team that can identify it. And also, typically that team has got really tight connections with brokers, and the brokers are the ones, for me anyway, that make the difference. They're the ones that help us be successful, because the reason why we're in alignment with the brokers is they want to make money. They want to help sell it for their customer. And if we're an easy group to do business with and we perform well and we're not going to retrade, they want to deal with you. So that deal sourcing is really important. The underwriting and due diligence, that is the secret sauce in terms of to determine, is it going to work or not? And there's a lot of people that can underwrite a deal, but it doesn't work. And so there's a lot to that. And like I said, every property has its own story. Every underwriting has its own strategy. And there's, I will say, multiple strategies you need to have on looking at it. And you assess the risk reward for that. And you look at the exits. You want to have multiple exits, and you want to be able to flex your deal in terms of what happens if. And we always flex if things are going bad, the GPs get 0, our investors protected. So take the 30% out of the equation. Are they still good? And if this answer is good, we've still got it handled and we feel good about it, then that's to me profiling the risk. The raising of the capital, of course, that's where the LPs come in and trying to assess where it is, who they want to invest with, and assessing the group, assessing the deal. And then, of course, then we're going to complete it. And this is where the real heavy lifting happens, is when you acquire the property, because that's when the money's made and the cash flow is made and everything. So that's the 5 years. So that is so important that you've got the right team asset managing it, and that they're holding people accountable, which is the management company, to actually do the heavy lifting, the work. And so that's where you have your weekly or bi-weekly meetings, depending on what stage the property's in. And then the disposition, of course, at the end, it's just like buying one, except reverse. You have to make it ready to sell. And then basically that's unlocking the profit for everyone. And so you have to determine what's the timing for that. When does it make sense? I'll say in our cases right now, we look a lot of times where we're all really happy with the cash flow, but a few of us maybe want to get out. So we'll look to refinance the property at that 5 or 6 year mark and buy those people out based on what the lenders appraised it at, and allow them to move on, giving them their cash out and making a great rate of return, and the rest of us to continue to enjoy the cash flow and future appreciation. So different people, different things. So anyway, that I just wanted to touch base on that, because that's really a nice wrap up as to how it all flows and how people that are thinking about going with syndication, this is it. This is the cycle.
No, that's great. Thanks for sort of, wrapping that up. And I also wanted to, find out, like I said, there's still so much to uncover from you. And, but while we get to that process, maybe chip away slowly. What is a sort of any final advice that you would have, to offer to the audience, especially for those who are considering to, like investing in a syndication for the first time? What are things that, like that they should sort of consider and take into account?
Well, I think we've touched on quite a few of the things, but I would say, okay, this is my risk averse side talking. Whatever you're investing, make sure you can live without it. In other words, if it went bad, can you afford to invest it? If you can't, then I don't know if you should be. That'd be the first thing. And that's more like me talking to my daughters right now. But I'll say that, assuming that's it and you've got everything under cover, like in control, and yes, you have the money that's available to invest, then really decide what type of asset you like. There's usually things that you're attracted to, and decide what that looks like. The age of the property, is it multifamily? Is it medical centers? Is it RV parks? I mean, there's so many different asset classes. I stay in my lane with the multifamily. I love it. There's so much opportunity there, and it's what we've done for over 30 years. So that's us. But I'm not saying that's the be all end all, because there's lots of other people doing incredibly well with other things. But you need to feel good about what it is. And then I would say watch some webinars. YouTube is a great source. Get a sense of how it's doing, researching it in terms of the market cycle, that sort of thing. Ask who you're, maybe if you're talking to someone about an investment, how they see the life cycle of the real estate right at this point in time. Is it a good time to enter? Are we in the upside or the downside? And then really at that point, assess the team. And that's where you're at with it. And then if it's all still feeling good, then you should be enjoying some mailbox money coming in and some tax benefits, and have a smile on your face that you're now taking your first step to hopefully building passive income and appreciating income to allow you to get to that better state of whatever that may be for you. For me, it was time freedom, but everyone's got their own definition of what that may be.
Yeah, no, that's great. Thank you for, sharing that. I know we have 5 minutes. I don't see any other questions that have come up. But folks, if you have any other questions, feel free to, add that. So we'll use the next, couple of minutes to answer any of that. Or if you can also raise your hand if you want to ask the question, anything, right now. But I did sort of think about one thing. especially as an LP, after you've decided that, you've gone through the process, you've done your due diligence, you've, decided you want to invest as in multifamily as an asset class, just because, just recent data that's shown, talks about how we're becoming a renter kind of a, like nation, isn't it? Versus, owning. And with that in mind, we know that, okay, if that's the path and that's what, as an asset class that we're moving, in wanting to invest in, can you talk about what kind of distributions, are we looking at getting? I know you talked about cash on cash at 7%. How often do we get that? Is that a monthly distribution? Is that, quarterly distribution? What is it that you've usually seen, and what do you guys do, Jim?
Yeah, I've seen monthly for some groups. Ourselves, we do quarterly. Part of our strategy, quite honestly, is that if we're doing capital expenditures, and you have a draw process, the reason why we like to do it quarterly is that we are spending money and then we time putting in the draw process to get that money back in, which then allows us more cash. And that also gives us more cash flexibility to pay the investors. So we've got a strategy behind it. And also it's less work to pay it every month administratively. But that said, I do see groups paying it monthly as well. It all adds up to the same number. It's just that we'll pay 3 months, like instead of monthly, it's the equivalent of 3 payments at one time. So that's kind of how we look at it. It gives us, you can in a property, depending on the time of year, yo-yo in your cash flow. And so as an example, if you're workforce housing a C-class property, tenants can, during the Christmas period, have to make a choice if the income's tight, especially it's been a very tough economic climate right now. Do I buy Christmas presents or do I pay the rent? And so we'll see tenants do promises to pay and we'll work with them because they've had great track record, but we won't get the cash flow in maybe till middle of January, towards the latter part of January, and they'll catch up. They always do. If not, then they're not going to be with us. But generally, the tenants we've worked with, so we know that. But if we had a distribution, then it gets really tight to do. So we know, being in this for a long time, doing it quarterly gives us that flexibility. So that's us, but a lot of groups do monthly. Some do annual, by the way, too. I've seen that as well.
Oh, I've never heard of that, but yeah, no, good to know. Yeah. Well, I don't see any other questions that have come in, but this audience, hopefully had, a lot to take away. Thank you, Jim. And thank you everyone who joined, us today. As we sort of wrap up, I'd like to, invite you guys to all connect, with us further. Jim, what is the best way to, reach you?
Yeah, so westkeycapital.com, all one word, Westkey Capital. .com, you'll get to the website and then you'll find me there, or Jim Stewart, Stuart. So Jim Stewart at westkeycapital.com is my email. Those would be probably the easiest ways to get a hold of me. Always happy to talk to folks as well. And then if you're sending out a replay of this, we can add that slide of information into it as well. Yeah. So it can be there, that contact information.
Absolutely, will do. Yeah, so, please feel free to follow up, as when the recording goes out, we'll be sure to sort of add that, information. Yeah, let's continue the conversation and, encourage you guys to discover how, multifamily syndication can, be that sort of powerful addition for your investment portfolio. And we're here to support you guys, learn anything else that you have additional questions on. So please feel free to reach out to us. Thank you again. Thanks, Jim.
Thank you, Rashmi. Thank you, everyone.